breakout session. So very nice to meet you all. I'll get started now. I know that we only have 30-minute segments of time. This will not be a ton of self-promotion. Really, I want to make this very educational, really share a lot of knowledge with all you guys about where we are within the insurance marketplace. Not just hyper-specific to California, of course, a lot to do with California. I know that you guys are heavily concentrated in California, but I really want to share with you the national landscape as well, kind of a series of events, right? So historically, what's happened, how did we get to where we are, and then what really just happened in the very imminent, recent history here with the LA fires, and then what the near-term future looks like, right? So what do the next 24 months look like insurance-related for California? So again, I appreciate all your guys' time. Very nice to meet you. And again, I'll try to make this mostly informative, all right? So Turbo Insurance Group. Myself, my name is Miles Johnson, founder, president. We do have a partnership with C2 Financial. So quickly, just a few things that we do on behalf of C2. We do have a quote portal that is created specifically for C2 members. It's c2.turboinsurance.com. Very simple. Go ahead and write that down. c2.turboinsurance.com. You're free to go there, put in an address anywhere in the United States, and you can get a real homeowner's insurance quote. So if you're looking like UWM, trying to get all of the documents in for ultimate submission, things of that nature, that's what we created that service for. Excuse me. So again, c2.turboinsurance.com. Another huge unique thing that we do at Turbo is every single client of ours, we run what we call refi retention on. Okay, it's something very unique that we do only specifically for certain partners, C2 being one of those. So what am I talking about? Every purchase loan that you guys do right now, I'm sure you all are aware that it's 2 to 3 refis over the next 36 months, right? Well, as an insurance agency, we field dozens of mortgage e-clause updates every single day. We don't just blindly go in there and update those mortgage e-clauses. What we do is go back to the original referring LO and brokerage and notify them, hey, we just got this mortgage e-clause update. It looks like they're going to close a refi with Loan Depot or Rocket 20 days from now. Get in touch with your client, see if you can get in front of this thing. Right? So again, that's something proprietary that we do for partners. So if we're working together, if we have a client that is shared with a C2 LO, just know that we're going to run that refi retention on every single one of those clients. So you're going to get notified anytime we ever get a mortgage e-clause update. All right? So enough about Turbo and what we do. Let's talk about the insurance marketplace. This right here was prior to what happened in January of this year. So as you can see here in 2024, these are billion-dollar weather-related events across the United States, right? You can do some quick math here. There's over 30 of them. So every single year, these are going up by 4 to 6. And as you can see, it's not just one peril meaning type of risk. It's multiple. It's hurricanes, it's convection storms, it's hail, it's freezing, it's now the wildfires, right? So you can't just isolate a single kind of risk, and you also can't isolate one part of the country. Now, granted, the Midwest looks like it got beat up pretty bad last year, right? But again, what's 2025 going to look like? Well, right away in January of this year, we had the worst wildfire in, the state of California's history, right? We're looking at probably $70 billion in damage in 2 weeks. And that's how we got to start 2025, right? So point being here is that the weather is extremely unpredictable and it's continuing to happen more and more frequently. Really, one thing to take away from this slide is insurance rates by and large are going up. They're not going down anytime soon. As far as an insurance industry, right? You saw the macro data, right? So the billion-dollar weather-related events. Let's talk more hyper-specific financially. Right here you can see how, as an industry, personal lines has performed. And if you look at this graph over here on the left, you'll see that 2020 all the way through 23, the insurance carriers collectively are losing 6, 4, and 10 cents for every dollar in written premium they've collected. So collectively, the insurance industry has not made money in 4 years. That's why you're seeing premiums go up at such an alarming clip. 30%, 50%, 100%. Big thing in California right now is people would love their premiums to go up 100%. They're just getting non-renewed altogether, right? So capacity and availability of products is a whole new thing that we're dealing with in this hard market. You know, insurance rates are cyclical just like mortgage rates, right? They're going to go up, they're going to go down. We have hard markets, we have soft markets. The thing that we've been combating since 2020 is the capacity of product. That is a new struggle. This is probably the hardest market in the last 40 years. If you look over here, as you can see, as premiums continue to increase, they still can't offset their losses, right? So over here we actually have 24 net written premiums, $939 million, and yet still lost almost a penny for every dollar that they took in. So again, when you want to look at a macro level in general of what's going on within the personal lines marketplace, no one can make any money on property insurance, right? So what's the strategy going into 2025? Most carriers are trying to offset their losses in property through commercial insurance or through auto. So if you want any kind of light at the end of the tunnel to take from today, is your auto premiums should be seeing some reprieve. Most carriers that offer auto and home are decreasing their rates already across the nation. You're seeing auto insurance filings -10s, -25s. So all of the carriers are going to start getting really, really aggressive in personal auto to try to offset some of the unpredictability of the property marketplace. You guys probably have seen a lot of these headlines, right? This is what I was talking about. Rates going up is just one factor. But what do you do when the carriers just refuse to write business at all? This right here is more specific to California. Allstate, Berkshire Hathaway Guard, Geico, State Farm, these carriers have literally left. They've taken their state filings away from the Department of Insurance in California and said, hey, no longer will we write another policy. State Farm non-renewed 72,000 policyholders last year. 72,000. And they refused to write a single new policy. So all of these carriers right here made the decision, we can't even make our appetite narrow enough to stay in the largest state in the United States. As you saw from one of those prior slides, the personal lines marketplace, $939 million in written premium. They think about $150 million of that is in California. So if there was one state that you wanted to be in, it's California, and yet you just simply can't find a way to be here. And I'm going to get into that a little bit because it's not just from a carrier standpoint. Really, it's a very contentious relationship with the Department of Insurance. For those of you that do have a little bit of a broader scope of things and aren't concentrated solely in California, right here you can see the average cost of homeowners insurance across the nation. Again, not to continue to pick on California, you guys probably can't see this. Average cost of homeowners insurance in California last year was $1,043. To be honest with you, that probably should be something closer to $4,000. Just to give you an idea of how underpriced the average rate in California is and where rates by and large are going. If you can, and you probably can't, but the number one state up here last year was Oklahoma. Oklahoma actually had a great year. So everyone in the United States, with the exception of Florida and California, had a pretty decent year last year. But again, there's no way that in 2024, the average cost of a homeowner's insurance policy in California should have been $1,000. And I'm going to get into why that was. All that was preceding what happened in January of this year. So it was already pretty bleak. We didn't have a whole lot of hope going into 2025, and then we had January. Right? As I said, January, worst wildfire on record. There was 4 of them going simultaneously. If you can see here, you'll look at the damage. So you're talking about the Palisades Fire, 17,000 acres. The Eaton Fire, 10,000 acres. Sunset Fire, fortunately, only 42. You add the other 2 together, you're over another 1,000 acres. So collectively, you're talking about almost 30,000 acres gone in the first 10 days of the year. Unprecedented, unheralded, never happened before. I'll show you guys some more data points about it right here. As you can see, They got decades of data here, right? So in the 90s, 4 million acres for the entire decade. 2000s, 7 million, again, through the decade. You're looking at the 2010s, 7.7, not so bad, right? Only through 3 years, and we're already at 7.5 million acres burned. So just think about the delta that we're seeing there in terms of the acreage that's burning in California. If this stays consistent, which unfortunately it probably will, you're looking at 15 or 16 million acres burned this decade in the 2020s. This is by UCLA. They're talking about the economic impact of the LA fires. As you can see here from their study, they're ranging between $76 billion and $131 billion in property damage. So again, right away, most costly wildfire in history. And again, not a whole lot of hope as to what's to come after the fact, right? You're looking at other economic factors in here beyond just the property damage. You got the decline in GDP, you got wage losses. The one big thing that's going to be very interesting to see is the municipalities and the permitting of rebuilds. You know, we've had several conversations with people who wish their homes burned to the ground that didn't, because they don't want to deal with it. They're going to have to live in construction hell for the next 3 years, and their home value may have gone down 40%. So it's pretty tough, especially like over in the Palisades area. So how did we get here prior to the wildfires, right? How are we so under market to where the average cost of a homeowner's policy was $1,000 and natural rate was probably closer to $4,000? Well, let me give you kind of just a chronological background. So back in 1988, California passed what is known as Prop 103. Prop 103 limited all of the underwriting factors that an insurance company is allowed to use in the state of California. So a better example from home would be auto insurance. You know, all of you guys are in the mortgage industry, right? You guys have a ton of variables that go into underwriting the risk of a mortgage, right? Well, what if I were to tell you that take the 100 variables that you look at and you're only allowed to use 4. Pick your 4. That's what they did to all the insurance carriers. They said that we're no longer allowed to use actuarial modeling because past performance isn't indicative of future events. Okay, so we're no longer allowed to use modeling. On auto insurance, you're no longer allowed to use credit. You're no longer allowed to use someone's driving record. You're no longer allowed to ask them about the mileage that they drive every year, so you have no idea about frequency. They took away almost every single underwriting variable that you could use to get a more accurate profile of the risk that you were underwriting. Other things that came with Prop 103 were the watchdogs. So what ended up happening is every single time that an insurance company files a rate with the state of California, it has to be approved by the Department of Insurance. The Department of Insurance here in California became very notorious for the rule of 7. If you asked for more than 7%, it would never get approved. And even if you did get something approved, the average approval time was 18 months. So you're getting rate through that you needed 18 months ago. By the time you finally get your rate through, you probably need more. The other thing that comes along with that is the watchdogs, right? So the consumer watchdogs have the ability to sue every single insurance company and make them prove why they need that increase in the court of law. So you've opened up an environment where you make it very antagonistic between the insurance companies and the Department of Insurance. That's how you end up with rates that are 25% to 33% rate adequate, which has now caused an unsustainable marketplace. And because there's not a whole lot of hope on the horizon for how the Department of Insurance is going to work with the insurance carriers, what have they done? All of the majors, they simply took their ball and they went home. That's why Geico's gone. That's why State Farm's gone. That's why Allstate is gone. Berkshire Hathaway, gone. And when I say gone, they non-renewed all of their policies and they're not coming back. In terms of where do we go from here, right? So if your admitted marketplace, if a normal naturalized insurance marketplace is off the table for California, what is it going to be replaced with, right? You still have a gigantic concentration of people that need help, that need insurance. So what's going to happen, right? With all strife, with all of these kinds of situations, there's always innovation that comes about, right? So where I see things going, Florida has a really great model for a state-backed insurance company. It's called Citizens. The one thing that Citizens does really, really well is it depopulates its book every single year. What's going to end up happening here in the state of California is the California Fair Plan is going to expand tremendously. The California Fair Plan was out of money for the LA fires within 4 days. So there's going to be massive radical expansion of the California Fair Plan because, quite frankly, that is one of the only places people can even get insurance. You're going to see a massive rise in DIC policies. DIC stands for difference in conditions. So what they have been able to convince some of the insurance companies to do, excuse me, is to write policies that exclude fire. So you're able to go and get a homeowner's insurance policy that covers every peril except fire. You'll have to go and get fire from the California Fair Plan. That's been one of the compromises. HOA master policies. You've had communities that have voted to no longer provide coverage for fire. What is going to come about there? You're not going to be able to have loans in any of these places because they're not going to be able to meet any lender requirements. This is the exact same thing we're facing in Hawaii right now. For any of those in here that have any exposure to Hawaii, same exact things happen in Hawaii right now. These community boards are voting against having property coverage on their master policies. So what ends up happening is you can't write a loan on any of these condos in Hawaii because they don't actually have an HOA master policy. Same thing's happening here. These HOA communities are getting together and they're voting to not provide wildfire coverage anymore, which is going to cause a huge problem. Rise in non-admitted products. So a lot of the logos and the companies that I talked about earlier, they're referred to as admitted carriers. Everything that I just talked about with the Department of Insurance and having to get your filings approved before you can start charging those rates, non-admitted carriers do not have to go through that process. The big caveat is if a non-admitted carrier goes insolvent, if it goes into bankruptcy, there's no protection. So what you're having now is a massive influx of E&S carriers, non-admitted carriers that are coming in. The really, really big downside to the consumer is these policies are very poorly written. So all of the bells and whistles that people are used to having on their homeowners policies, they're gone. These are stripped down policies that are really just providing the bare minimum basics. But again, it's a way people can get coverage. Excuse me. Changing the terms and conditions. So what I do believe is also going to happen, the admitted carriers that do stay, you're going to see them start to even strip away a lot of the bells and whistles. It's very, very common in the, excuse me, the Midwest and in the East, like in Florida, for these policies to have separate wind hail deductibles because there's storms all the time. I think it's going to be commonplace here in California. You're going to have separate wildfire deductibles. And those deductibles are going to be massive, just like earthquake policies, right? So anyone in here that's a homeowner that has an earthquake policy, if you go look at your deck page, your deductible is probably 10 or 15% of the coverage A. Same thing is going to happen for wildfire. You're going to see mandatory wildfire deductibles on all of these policies here. Normalization. Will it happen? Yes. Again, as I said, normalization will be like, is there an actual marketplace again where, hey, your average consumer on a middle home, a middle American home, right? 2,000 square feet, it's worth $600,000 here in California. Can that person go out and get 4 options? Let's not even get to 10 or 12. Can that person go and find 4? Yes. Yes, we will get back there, but we're going to need some help, right? And so what is going to happen post LA fire? What preventative measures are we now going to put in place in these areas? With the burn off, what's to come after that? Mudslides, What happens when we finally have a really good rain season, right? All of that is going to grow back. What happens if we don't do clearing? It's going to happen all over again. So what preventative measures are the municipalities going to come in with to try to make things a little bit more controlled? Are there going to be controlled burns? Can we get away from some of the environmental things, right? For the greater good, quite frankly, of our own human society. That's what's going to be interesting to see, because the insurance companies aren't going to be able to do it alone. I will leave you with one thing on the Department of Insurance, because I'm beaten up a lot. So here in the great state of California, Ricardo Lara, who is the current Commissioner of Insurance, that is a publicly elected official. There are only 3 of the 50 states that have a publicly elected Commissioner of Insurance. So these guys, by and large, generally have political aspirations. Ricardo Lara has bucked the trend on that lately, so I will give him a lot of credit. He really is trying to work with the carriers to get normalization, so I am pretty confident that they are going to be able to find a middle ground. The problem is going to be, how long does that take, right? I know that for a lot of you in this room, insurance over the past 4 years has gone from kind of a hot button issue to, oh wow, people can't actually buy homes anymore because we just simply cannot find rates. I just want to let you guys know that through all of the channels that I just spoke about, while they may not be great products, we can still find a product for every single one of your prospects in the state of California, right? So you're not ever going to have a loan closing that just completely blows up because you simply cannot find homeowners insurance. We do have marketplaces for everything, no matter geographically how bad the wildfire score is, no matter how much coverage they may need, no matter how close to a fault line it is. We can still place 100% of residential property in the state of California. It just might not be pretty. So I appreciate your guys' time. I think I have a few minutes left. By all means, ask away if you have any targeted questions.
Has there been much chatter in the background about, you talk about the municipalities, will they clear brush and stuff like that?
Yeah.
What about building homes in Florida that don't fall apart in high winds or that don't burn in California?
Yeah, so great question. We're talking about building materials. So building materials that are fire retardant, fire resistant. So there is a lot going on with that. So like new builds, they have to have certain defensible spaces. There's certain things that you can do to your home to try to, make like a fire retardant coating around. So I do think that that's probably something that's going to come about with the municipalities as well, especially if you're trying to rebuild in those areas that just burned through like the Palisades or the Eden fire.
I have a question. Who are you talked about these non-admitted carriers?
Sure.
Process. Are these like the bamboos and the lemonades? Like, who are these carriers?
Yeah, so she's just asking like the E&S carriers, right? The non-admitted carriers, who are they? So Lemonade, Bamboo, those are still admitted carriers. So what you're thinking is more like Cincinnati, Chubb, Scottsdale Insurance, Lloyd's of London. Those are going to be more of the names that you see.
How do we, so we can essentially shop and get a quote for our clients?
Yes.
Can we customize like with condos, because that's almost all I do.
Sure.
Every condo policy is going to be different. I can say, you need a $50,000 loss assessment policy. Oh yeah, you've got 50 people living in your building, $500,000 of liability just isn't enough. Can we modify all of that as well?
Great question. So if you guys submit something through the C2 branded portal, can you customize it? The answer is actually no, you cannot. So it's going to put pre-selected coverages on there. However, that's going to get an assigned contact on our end, which you can then have a dialogue with.
So then there's a rep on the back end that I can call.
100% of the time.
This HOA, I'm running this right now, the HOA requires each homeowner to have $1 million of liability. I can then communicate that directly.
Yep, yes. Yep. One more if I have time.
Do you actually do, and I'm thinking of my own condo building, do you actually do it for the building a master HOA policy?
We do, yes. So, obviously I came today to talk mostly about residential homeowners insurance, but Turbo as an agency, we're national, so we write in all 50 states, and we have divisions for everything. So we do home, auto, life, commercial, small business. Yes, we do everything. We actually insure C2.
So, because I manage several HOAs, when I'm shopping for insurance and I'm running into deny, what do I do? How do I contact you to quote them?
So on a commercial side, that wouldn't be something that you submit through the C2 portal. The C2 portal is specifically designed for residential property, for homeowners insurance. That would be something that we could just talk about offline. Yeah.
You guys do flood insurance?
We do flood. Oh yeah, all the time. And one thing just real quick about flood is just because someone's property is in an X zone doesn't mean they don't need flood. I would show you, I wish I would have had a slide about flood. Right now we're talking about fire, so it's kind of the polar opposite of it. But 80% of flood claims happen in X zones. 80%. So yes, in the event that someone is by a large body of water or is, you know, at a little bit of an elevated risk, it's absolutely something they should consider.
Obviously, there's some states like California, Florida, and whatnot that are getting smashed.
Yeah.
In Seattle, Washington, are we seeing premiums across the board increase, or are there protections in place with the state agencies to reduce or to keep from that happening?
Yeah, it's a great question. So geographically, right, can they scope rate increases to the places that really, quite frankly, deserve them? And unfortunately, no. So most of the large national riders, they're punitively hitting everyone. Because what they're looking at it is kind of like a causation, right? If I'm losing money in California and Florida, can I make up for it in Texas, in Oklahoma, in Kansas? And so, yeah, unfortunately, rates for everyone holistically are going up. I appreciate your guys' time. Thank you very much.